$3.5 billion in work-related deductions get knocked back by the ATO every single year. Most of it comes from 10 specific claims that almost every Aussie gets wrong. I'll show you all 10, and the one that catches the most people out. That's your money. Gone. And every one of these is a fixable mistake. 10 million Aussies claimed deductions last year. $28.3 billion worth. The ATO says $3.5 billion of it was wrong. I'll show you the rental mistake 9 out of 10 landlords make even with a paid tax agent, the single line item that's 42% of $1 billion gap on its own. And one claim so absurd it became a national warning, starting with the one that catches more people than anything else: working from home. It's the most claimed deduction in the country right now. About half of the 10 million plus claimants used a work from home deduction last year. The ATO gives you 70 cents per hour under the fixed rate method. That rate covers your internet, your phone, your electricity, all bundled into that 70 cents. But here's what people do. They claim the 70 cents per hour, and then they separately claim their internet bill, phone bill, and power bill on top of it. That's called double dipping. And it's the ATO's #1 individual audit trigger this year. You pick one method or the other, not both. Their systems flag it automatically before a human even looks at your return. And that's the one. The deduction that catches more Australians out than any other claim on the books. Right there. Working from home, double dipping. But it's not even the one that costs the most money. That one's coming. And it's a completely different deduction. Now you might be thinking, what about the actual cost method? You can use that instead. But it means tracking every single expense separately, keeping receipts for everything, and calculating the exact work percentage of each bill. Most people don't want that headache. So they use the fixed rate. And then they accidentally double dip because they don't realize what the fixed rate already includes. Number 2, car expenses. You get 88 cents per kilometre for work-related driving, up to 5,000 business kilometres without needing a logbook. Sounds generous. But here's the thing. Your commute does not count. Driving from home to your regular office and back is never a work-related trip. Never has been. And yet thousands of Aussies claim it every single year. Driving between 2 work sites during the day. That counts? Home to the office? Never. If you genuinely drive more than 5,000 business kilometres, you need a logbook. That logbook has to record every trip for a continuous 12-week period. Business and personal. Both directions. If you can't produce it when the ATO asks, the entire claim gets thrown out. Not reduced. Not adjusted. Gone. Number 3. This is where it gets genuinely ridiculous. Personal items claimed as work expenses. A mechanic tried to deduct a gaming console, an air fryer, a microwave, and 2 vacuum cleaners. All rejected. A truck driver claimed swimwear because, and I'm quoting the ATO directly, it was hot where they stopped in transit. A fashion manager claimed over $10,000 in luxury branded clothing for work events. And then there's the one that became legendary. A real estate agent tried to deduct $30,000 in dental veneers. Their argument? They needed to look professional to sell houses. The ATO rejected it instantly. But this story perfectly illustrates the test they apply to every single claim you make. Is there a direct connection between the expense and how you earn your income? It helps my image is not a direct connection. I physically need this to perform my job is. That's the line. And most rejected claims fall on the wrong side of it. Number 4, phone and internet. You use your phone for work? Great. The ATO wants itemized bills and a 4-week usage diary showing the exact split between work and personal. Claiming 50% because it feels about right is not a method the ATO accepts. It's a guess, and they treat it exactly like one. So that's 4 down. But here's the thing. Those first 4 are the warm-up. Deductions 5 through 10 are where the real money disappears. And one of them, just one line item, is responsible for nearly half of an entire $1 billion tax gap. Let's talk about rental properties. The ATO published a stat that should make every property investor in Australia deeply uncomfortable. 9 out of 10 rental property owners make at least one mistake on their tax return. 9 out of 10. And 86% of those people used a tax agent. They paid a professional to do it right. And it still came back wrong. That is how tricky rental deductions are. Even the experts get caught. Number 5. Repairs versus capital improvements. Fix a leaking tap? That's a repair. Deduct it this year. Renovate the whole bathroom? That's a capital improvement. You can't claim it up front. You depreciate it over its useful life. But landlords keep claiming full renovations as same-year repairs. And the ATO keeps sending adjustment notices. The dollar amounts here are huge. A $10,000 bathroom renovation claimed as a repair gives you a big fat refund this year. Depreciating it properly gives you a smaller deduction spread across many years. The temptation is obvious. But so is the ATO's response. Number 6. Interest expenses. And this is the number I teased at the start. The rental property tax gap sits at $1.2 billion. Interest expense errors alone make up 42% of that. Over $500 million. One line item. Nearly half the entire gap. Here's how it happens. You refinance your investment loan and pull out equity for something personal. A holiday, a new car, a bit of extra cash, but you keep claiming the full loan interest as a rental deduction as if the entire loan is still for the property. The ATO data matches your loan records against your bank. They can see exactly how much went toward the investment and how much funded your trip to Bali. And when the numbers don't match, they adjust your return and send you a bill. So right there, deductions 5 and 6, rental repairs and rental interest, are the biggest dollar problem on this entire list. If you own an investment property, these two deserve more of your attention than all the others combined. Number 7, self-education. You can claim courses, textbooks, even travel to a conference, but only if the education directly relates to your current job, not the job you want next, not a career pivot, your actual job right now. An accountant studying advanced tax law, deductible. An accountant doing a real estate license, not deductible. That line is firm and the ATO doesn't budge. They don't care about your 5-year plan. They care about what you do for a living today. Number 8 is painful. Clothing. You cannot deduct a suit. Cannot deduct black pants. Cannot deduct a nice shirt, no matter how much your workplace expects you to wear it. Unless it's a registered uniform with a logo, occupation-specific gear like a chef's checked pants, or protective equipment like steel cap boots, the ATO says no. This catches people every year because it genuinely feels unfair. You bought the clothes specifically for work, but the ATO's test isn't why you bought them. It's whether you could reasonably wear them outside of work. If the answer is yes, it's not deductible. End of story. Number 9. Tools and equipment depreciation. Buy something for work under $300, write it off this year. Over $300, you spread the cost over the item's effective life. A $200 drill? Claim it now. A $400 laptop? Depreciate it across 3 years. People get this wrong constantly because the threshold feels arbitrary, but the ATO enforces it down to the dollar. Now, before I get to number 10, you need to understand what happens when any of these go wrong, because the ATO doesn't just ask for the refund back. It goes further than that. They charge interest on the amount you shouldn't have received. Then they stack a penalty on top. A careless mistake attracts a 25% penalty on the tax shortfall. A deliberate overclaim can cop up to 75%. That's not a slap on the wrist. That's a financial hit that wipes out whatever you thought you gained. Picture this. You earn $90,000 a year. You claim $3,000 in deductions you can't back up with records. At a 30% marginal rate, that's about $900 in tax you received, but shouldn't have. Add the 25% careless penalty. That's another $225, plus interest on the full amount. And that's for a mistake you didn't even know you were making. Not fraud, not a scheme. Just not keeping a logbook and a few receipts in a drawer. Number 10. The fastest growing problem on the ATO's entire radar. Crypto and side hustle income. This one's different. It's not a deduction you're claiming wrong. It's money you're earning and not declaring at all. The ATO now data matches directly with every major crypto exchange operating in Australia. They know what you bought. They know what you sold. They know the capital gain you owe. And if you didn't declare it, they will find it. It's not a matter of if anymore. It's when. The data is already sitting on their servers. Same applies to gig economy income, Uber, Airtasker, Etsy, weekend tutoring. If money came in and you didn't report it on your return, the ATO treats that identically to a fraudulent deduction claim. and for 2026, they've specifically flagged undeclared income as one of their 3 top enforcement priorities nationwide. They've also added something new this year. The ATO is now publicly warning Australians not to rely on AI tools for tax advice, which is honestly a bit funny, because every single mistake on this list has been happening for decades, long before anyone asked a chatbot how to do their tax return. So here's what this all comes down to. If you remember one thing from this video, make it this. The ATO is not out to catch you being creative. They're catching the same 10 mistakes from millions of people, year after year. $3.5 billion in wrong claims. And nearly all of it comes down to people who simply didn't know the rules. Not dodgy, not scheming, just uninformed. A logbook, some itemized bills, knowing the difference between a repair and a renovation, knowing you can't deduct a suit. That is the entire gap between keeping your refund and handing it back with a 25% penalty stacked on top. One more thing worth knowing. There's a proposal on the table right now for a flat $1,000 standard deduction for work-related expenses, potentially starting from 2027. If it passes, millions of Aussies won't need to stress about half of this list. But it's not law yet. So this tax year, these 10 rules are your rules. Keep your records. Know what actually qualifies. And if a claim feels like a stretch, it probably is. If this helped you out, a sub goes a long way.